National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
And on today's show, Section 79 plans with special guest Ken Davis, CPA.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide network of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And here we are, day 3, with Ken Davis, CLU, ChFC, CFP, and CPA, talking about Section 79 plans. And the reason we're talking about it all this week, and again, if you've missed it, hop out on our site, www.brokersalliance.com. As soon as you come to our homepage, click on the On-Demand red button, and it'll put you right into Monday and Tuesday show. I think you need to kind of watch this in its building. We're kind of building up. It's kind of, we're gluing the pieces together. So we're talking about Section 79. I have Ken on today. Welcome again, Ken, to our
Thanks, Stephen.
Day 3. You doing all right?
Yeah, I'm doing great.
Okay, I'm just making sure, because we're talking about a concept that if you could learn it, and again, Ken's even available for the bigger tickets, because we have a lot of guys that are talking to CPAs, attorneys, trust officers. You're not going to see the light of day into these gatekeepers, and not only his credentials, but his understanding. He teaches at the CPA Society and teaches our language, life insurance. And in this product of Section 79, we're using indexing. And I know, Ken, that you kind of have a special thing about that. We're going to get into that a little later on in the week, of why we're using indexing over whole life, current assumption UL, why we don't really want to do variable, right?
Right.
So there's a lot of reasons why we're doing it, and Ken will tip us off on that and give us his CPA version of this. But Ken, when I'm looking at Section 79, we talked a lot about the code issues and things of this nature in the last 2 shows. But today in day 3, I want to really talk about, when I'm talking about a good candidate, I really want to get our prospecting tools down today in this first segment. When we're looking at people, it's how would you like to match a great idea with the wrong client, right? And I see this happening all the time. We get qualified, pre-qualified paperwork in on strategies, tactics, even underwriting issues, and I go, this doesn't match up.
Yeah.
Why are we selling this product?
Sure.
So, Ken, let's talk about who qualifies. What are we looking for? Give me my target audience.
Well, what's kind of cool about 79 is some of our agents maybe have spent more of their time with individuals and family situations, maybe even estate planning cases, but now we're really entering into the realm of business people. Small, medium, large businesses where the owner and key employees are frustrated. They're frustrated because there's a 401k plan in place, but they're getting checks back at the end of the year because the contribution levels weren't there. The plan administration people say, hey, I'm sorry guys, you over contributed, here's your money back. Yeah, it's not a pleasant thing at year end when you think you've got your tax planning done. So Section 79 really goes for taking care of the owners of these businesses. I mean, after all, they're the ones footing the bill. And they're paying all the money for the administration, taking the legal liability of having a plan in place and the potential losses in markets and what that might do and anger some of their employees that could sue. So cost of administration, complexity of administration, matching contributions, and what do they get? They get real limits on their contributions, and they don't like it. Now, there are additional qualified plans these days that we really haven't talked about in the other shows, segments. Cash balance plans, which are combination defined benefit and defined contribution plan, which to a large extent I've seen numbers quoted of about 85% of the money go into the owner's hands. However, there's not only the complexity we've talked about, but there's also, once you start making contributions to something that has a defined benefit plan element, they have to continue to make contributions, and if they want to stop it, they have to ask permission of the IRS and go back and pull it apart. So it's more complicated. You're kind of a little bit more stuck. Yes, there are reasonable flexibility in those contributions over the years, especially if you put a lot in up front. But the 79 plans can be stopped pretty much at any time. I mean, yes, like any life insurance policy, if you stop funding it, the projections and illustrations you have aren't going to come out the same way they were.
But you were talking about we're under, on those other plans that you were addressing, that's under ERISA. We have to recalibrate. I'm thinking defined benefit plan, right?
Right.
If we want to stop, we want to get out, well, then we have to recalibrate the whole thing.
Right.
We have to make sure our exit strategy complies with IRS code.
Yep.
I don't think we have the same kind of mess here.
No, we don't.
It's
much cleaner.
It's much cleaner. Now, as you pointed out, though, I mean, once we hit our schedule, the numbers are only as good as what we scheduled the premium commitments to be.
That's right.
So that being said, though, and getting the deduction up front, and we've already chose our chassis, I'm thinking I'm going to an employer. I'm looking at it a C Corp or a LLC that's taxed like a C Corp, or that he's willing to construct a parent or an umbrella company that is C Corp to take care of his other subsidiaries.
Right, or a finance company, billing company, leasing company, stuff like that. It has to be a legitimate business purpose. The C Corp requirement is an issue, but most often we can overcome it. It's not a big deal. But we're asking who are good candidates. Well, they have to be business people, and even more so in tough economic times, if you're going to be contributing, you got to have money to contribute. Now, the good thing is, logistically, how it falls out most of the time, even though there's non-discrimination rules, the vast majority of it, typically 95%, gets in the hand of the owner.
Okay. And is that because the employees generally are not going to pick a permanent product?
Well, what happens is this. Unlike a qualified plan, if an owner contributes to the qualified plan, there's no taxation to the employee. So are they going to say yes to that benefit? Of course they are. They're not going to opt out even if they could. In the case of Section 79, the employee has the choice. And the choice, if the owner's putting in cash types of plans, cash value life insurance, indexing in this particular case, they have to offer it to all eligible employees. And the non-discrimination rules indicate that this whole group of people have to be offered the Section 79 plan. But what actually happens is the employee says, I'm making $40,000 a year and you're going to put $8,000 in premiums into a life policy and I got to pay taxes on 70% of that, $5,600. I don't have the cash to do it. I don't want it. Can I opt out? Yeah, you can opt out. Well, what do I get? Well, you get free $50,000 term insurance. That's what I want because I don't want to pay any more taxes.
So the vast majority of reaction by employees are pretty much down this line.
Right, and I want to make a really clear point here. We've been in this insurance industry for a lot of years, and we've seen various provisions of the code and concepts abused, and just way beyond what was intended by the code. We don't want the Section 79 to grow up in that situation where we have people abusing the situation. So in this particular case, there's potential of abuse. You have to make sure the third-party administration company knows what they're doing, that whoever is getting in front of the employees is being very clear. This is a benefit, this is how you benefit, this is what we're willing to put away, and those are the pluses. The one big minus is the tax issue. As long as it's presented correctly, cleanly, appropriately, shouldn't have any problem with this whole thing. But I'm afraid that if this becomes popular and a lot of people are saying, oh, this is for the owners, that may bring the spotlight on, and then Congress says, nah, this isn't working. So we have to make sure that we're presenting properly, that the employee understands what their opportunity is. Then if they turn it down, great.
I think one of the fundamentals, because we're not in the same land. Section 79 is nowhere near the same area as 419 AF5 and AF6 plans were.
Correct.
Or the abuse of 412I.
Right.
So we're way down the middle on the law. But the big thing I like about this, Ken, when you talk about it is we're going to offer all the ideas. Some people may say, I just want the 50,000 term. Some say, hey, I just can't afford that, like you said, and they punt for that. But they could also buy term. Couldn't they buy term with us?
Well, yeah, you can have higher levels of term, but in this particular case, there's costs, there's economic costs that get passed through as well. And the fact of the matter is, there's two separate computations for taxation. And the fact is, most employees just want the free $50,000. They don't want to mess with it.
Let's say if I'm sitting there with owners, rainmakers, let's say owners and key employees, rainmakers, people that they want to touch on. And I'm looking at this. We talked about earlier show, some of the lower numbers are about $20,000, $25,000. Some of them are up to $100,000 because I think the cap
or better
caps on that or more.
Well, yeah, for the lower end, the caps for 9 or fewer employees, one of the insurance companies that's a big provider caps it at $100,000 premium. The other one bases it on a multiple of salary and whatever falls out in terms of cost. And then over 10, it's generally 200,000 or more is the high end, or basically 10 times salary. So we have much higher limits than typical. And so yeah, you're looking for somebody who's frustrated, wants to put money away for retirement, wants a relatively safe way with indexing strategies to put money aside, and wants some tax benefits. But the big thing is they got to have cash. Well, who in the world has cash right now? Well, a lot of doctors still make very good money. Surgeons, anesthesiologists, groups, stuff like that. Those are there. High-tech companies. I frequently in the marketplace run across people with software companies, hardware, stuff like that. They're making large sums of money. And so anybody that's flush, that's doing well in this economy, are good candidates. Maybe some attorneys, maybe some CPA firms, professionals. One of the things we haven't talked about is qualified plans have full protection against creditor claims. Well, in various states, and it's state specific now. And for instance, the state of Arizona, where we are, given some minor requirements, we can protect the cash, unlimited amounts of cash and life insurance against creditor claims in the state of Arizona, as long as it's been in there 2 years or more, wasn't put in there to avoid lawsuits, and it's left to the kids. There might be a couple other things, but that's a law. So in specific states, you need to make sure your law does, whether it does or not, but it potentially is a creditor protection as well.
Well, now we've kind of defined a little bit about what we're looking for. The news says there are trillions of dollars sitting on the sidelines in these companies, in these businesses, waiting to see the election results, waiting to see if the market's going to, settle down and become somewhat stable and predictable.
Yeah.
We know the money's there, and we've just laid out basically who we're target marketing on this. So I think it's a good idea to come to people and say, this is a great idea. And remember, there's only a handful of carriers that are playing in the indexed universal life that are already set up to do Section 79. Now remember, heads up, a lot of people have IULs, but this plan is specific, and the carrier has to have their admin already set up. Isn't that so?
Yeah, they're set up and designed to be Section 79 friendly, and the big one is the simplified issue is for 9 employees or less. No, they're non-med applications. They have questionnaires, but no blood, no urine, and no attending physician statements. And so the insurance companies are taking a substantial risk by not having that data available. That's what makes it a group type of product, is a simplified issue, and that's why it fits Section 79 and oddly for 9 employees or less.
Well, and I think about a 9 employees, because that's a nice turnkey, simplified issue. I'd be looking at a 9 employee C Corp, right, or related to a C Corp, because that to me is a target market. I want to hit it. It's kind of upper middle class affluency, 9 and below, right? Somewhere in that vicinity. And that's what I want to do, is kind of look always at that kind of market. And we can give you examples, especially physicians that we've talked about before. Prime example, and by the way, way easier than like Section 831B, captives, right? A lot easier to talk about, and a lot easier for us to teach and understand. And remember, Ken's here for you. If you have problems, you just call him right here. Well, you're listening to the Business Insurance Zone, the show that focuses on insurance in your practice. You can write me at thebiz@broker.com or call me toll free 800-290-7226 extension 147. Ken and I'll be right back after a word from our premier provider, our own underwriter, Brokers Alliance, leading authority in insurance products.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Welcome back, everyone, to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and interviewer extraordinaire, well, at least in my own mind. Before moving forward with anything we're talking on the show, especially Section 79, touch base with your CPA, your tax attorney, and of course, your broker-dealer compliance department. If you want to call us, you can call us toll-free, 1-800-290-7226 for any of your quotes or questions on Section 79, and also life insurance, DI, LTC, group pension plans, and annuities. It's not what I know, it's who I know. And that's why I have Ken Davis, CLU, ChFC, CFP, and CPA on the show to talk about Section 79, and we're using Indexed Universal Life with Section 79. A lot of you people that are already selling Indexed Universal Life, especially for income, you're already in the game. We're just going to show you some of the entry levels or introduce you into Section 79, which we think in 2012 is going to be a hot prospecting idea. And speaking of prospecting, Ken, welcome back to our second segment.
Thanks, Steve.
We're looking at some of the things we talked about. 9 or less employees, right? We're looking for people that got some cash, and we've been hearing all throughout the news, all these businesses have cash. They're looking for opportunity. This is a huge opportunity for tax deduction, tax deferral, and if done right, tax-free coming out. I'm looking at some of the C Corps that you talked about, because now we know what C Corp. Now let's look at the specifics. And I'm just curious, management companies. Give me a couple examples of what a management company might be.
Well, I've got a particular, let's say that you have a company that is a vendor and they're selling equipment. And there's the owner, the chief operating officer, the chief executive officer, the chief financial officer. Those are management types of administrative function. There may be partially, in some cases, like the COO is going to be in operations. But the people at the top are more management. So what you can do is you can set them up in a management company and contract with what was the whole company now becomes the operating company. And there's just a contract. The operating company pays the management company for services. And it could be for renting space. It could be for assistance.
And a lot of these companies have already done this.
Well, sure.
There's a lot of management companies out there.
Yeah, and pretty much, at least here, we have a whole lot of LLCs here in Arizona, small businesses. So most of these companies that we do here are going to have to set up a C Corp. Or the LLC can choose to be treated and taxed as a C Corp, even though it's an LLC.
Let's just talk about that, because I think that's a very important thing, because everybody says, man, I am not going to the employer and telling him he's got to reinvent his entity. Because a lot of them, and not only in Arizona, but in several states, LLCs are still hot.
Oh, sure.
They're basic entity. So you're telling me you could, even though you're setting as a pass-through LLC, you could kind of change that without a lot of maneuvering and move it to an LLC paying like a corp.
Yeah, LLCs can choose to be taxable as a C Corp. That creates some other issues in terms of, you get to zero out the taxes for the year. So basically, you take whatever earnings are and you bonus it out to zero out the income at the corporate level. And this is where their attorney and accountant are definitely going to be involved in this process. But you know what? It's a bit of a hassle to bring these people in, but they're necessary and they're going to have to be able to do this. But the tickets are large in this, at least $25,000 typically or more, 50 to 100,000. It's worth a little bit of effort. And you know what? This is one of those situations, if you do it right and you do what we advise you to do, when you run illustrations and stuff, you may very well find what I did with that one case I was telling you about, where they started off with a recommendation of $36,000 at the agent level. After the CPA got a hold of it, he said, no, I want to double it to $72,000. Okay, double the amount. Plus, he said, I have 2 or 3 other clients. So don't be surprised if instead of the gatekeepers kicking you out the door, this is a real life example. For instance, one of my friends who works in the qualified plan area had me come in and consult on trying to take care of the owner and key employees, and we brought 79 to the table. And this particular client had asked their attorneys, their accountants, their insurance agents, their stockbrokers, all these people to help take care of some of these solutions, and nobody knew how to take care of it. Well, I brought 79 to the table. I was a hero, and the client loved it. And so this can create some excitement. I mean, we're solving problems people are struggling with, taking care of the owners and key employees.
I've noticed, though, still, and I don't mean to trumpet your being a CPA, but I noticed that it seems to be a little easier for a guy like yourself to partner with our producers, get on the phone and talk to the CPA. There seems to be a much more greasing of the rails as we go into the people who really are going to make the decisions.
Well, yeah, and I think that's really one of the reasons why we're working together on these projects is that I know what the objections are. And the best way to deal with CPAs, instead of hiding and hoping the objections don't come up, just hit them straight on. Just go straight for things like they're going to think that there's expense loads and all that kind of stuff. And you say, yeah, you readily admit it, you put it there and say, hey, let's just start looking at the real economics of this thing. And when you can show them an 11 or 12% pre-tax equivalent rate of return, they'll get that. They'll understand it.
Now, in a previous show early on in the week, you were talking about there's that gross rate, less expensive, but then you get down to that net number.
Right.
That's net of everything. Is
Right.
that correct?
That's right.
So what net number are we talking about? And be conservative so we can get an idea.
Well, we've all run illustrations on indexed life, and we've run them at 7, 7.5, 8, 8.5. I think 7.5% is a pretty reasonable number. Who knows for sure? It's an estimate, but you run that through, and if you do what you guys do here at Brokers Alliance, where you squeeze down the expenses to an absolute minimum, have about a 50% target premium, the numbers come out really quite substantial, and over time, not in the short run, but over 15 years or more typically, the net returns after all fees, expenses, commissions, insurance costs, everything else becomes pretty good. I would say one of as always with life insurance, as a cash accumulation device, it's not going to look all that strong in the first few years because of the expenses and penalties and stuff like that. But after time has gone by, the penalties fade away or go away completely, and you have a chance for the tax deferral to catch up and pay for everything, then it becomes quite outstanding. And just be honest about that. When you're saying to the client, when you're looking for somebody that can do this, they have to be consistent, they have to be able to contribute. We haven't really talked about this. The contribution process is about 5 years. So it's about a 5-year commitment, and then the premiums stop. So you have to have some consistency and some patience with the thing. And that's we didn't talk about that earlier, but that's a big difference between a qualified plan and this is, you don't have those upfront costs with the qualified plans that you do here.
When you compare the cost of TPA, because somebody's going to have to administrate this,
Sure.
to qualified plan costs, pretty fair comparison?
No, they're very different. The third-party administration companies usually are insurance licensed, and they're going to participate in the commissions. And the two primary ones that we work with, or I've worked in the past, are about 20% of the commissions are going to go into their pocket. In one case, that's all they take, or maybe some minor ancillary fees. But that's the other thing, is you go to the client and say, there is no administration cost to you, Mr. Client, in this particular case. In the other case, it's nominal. It's $500 to set it up, and then $250 a year for 10 employees or less. Anything over that, an extra $25. And there are other administration firms out there. So to a large extent, the client isn't going to see costs, and they're going to say, well, gosh, you're paying $2,000 a year for your qualified plans, and you're doing this for free.
Now, the turnkey of using what we already have, established TPA relationships, and yes, they take a little bit of the comp, but I say totally great, because the moment you walk in there and say, no fees, this is not like I need a third-party administrator for an ERISA product, right?
Yep.
This is totally a new game in town, and I think that's really a big thing to lead with. And I don't want you to remember the numbers. That generally, as we talked before, the smaller the policies are, like $25,000. That's the small ones. So there's money to be had. I'd say share it all day long, and I have no problem trying to partner with people that are like yourself, Ken, because I know we're going to get the case.
Well, the fact of the matter is there's so many different areas in our financial services industry that are specialty. And the thing is, I spent a whole lot of hours learning the stuff, reading through all the materials, even some of the code sections, all that kind of stuff, so that I can come up to speed on this. I mean, if you got one or two key clients that'll benefit from this, do you really want to dedicate yourself to that amount of work and effort? And are you capable of doing that? And frequently the answer is no.
Right.
So just hire somebody out. We take a relatively small percentage to help you do it, and the numbers are large enough that there's still plenty at the end of the day. And then if you like it and get excited about it, maybe you do want to spend some, and then maybe start to market to it. That's up to our agents.
Well, I like the advocacy here, because it is really huge when I have a person that can talk to the gatekeepers, the CPAs, the tax attorney, the CFO in these C Corps, because that really puts a bit of authority it brings a comfort level, and actually endearing a trust issue.
Well, and it's interesting is I've watched a lot of agents, and they get angry. They're professionals. They're looking out for the best interest of their clients. And when somebody challenges their ethics and their integrity as a person, they tend to take it personally. I've been on the other side of this desk. I practiced for 7 years with large international accounting firms doing tax consulting, and the gatekeeper's there for a purpose. The client wants them to protect them. They see their job is to dig at it, pull it apart, make it less attractive if necessary. So the fact of the matter is that I know how they look at it when I present. I know I go right for those issues, those objections, and clear it up right from the start, so they'll start listening.
I like the idea of presenting IUL on a different platform that has tax deduction. Not all of it's going to be deductible, but 30-40% of the premium could be deductible. I also like the tax advantages that we always know we've always had life insurance. Now, when we've talked about qualifying, looking out these entities, C Corps, small companies 9 below, so we can have the easy underwriting. Now, you can get larger. I'm just saying this is the easy underwriting. We have a couple of carriers. One uses a 5-year point-to-point, which could be an excellent tactic, especially, I don't want to say the words I used to say in my old days, but I'll just say it here. It looks like springing forward cash value, but it isn't. And here's the best part about Index UL. I know I said it. What can I say? It's really good because it actually does some similar features that the IRS is already cool with, because we've been selling this product for a long time that has nothing to do with cheating the system.
We need to come back to that.
All right, next we'll talk about it tomorrow. You can watch tomorrow's show and today's show on HD 1080p right on our homepage, www.brokersalliance.com. You just click on the red On Demand section. You'll be right in there. And remember, we also do that at all our social networks, YouTube, Vimeo, Facebook, LinkedIn, and Twitter. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.